Every so often I'll hear a fact about the market that's so wild it will stick with me. And then I'll find myself sharing it with friends and colleagues because these types of facts have the power to change perspective. And this has been going on for years. And now there's like 5 facts that I can think of that have really altered how I view the markets. I figured why not package all of these up, share them, and talk a little bit about how they influence my perception of things, how they've changed my thinking. Let's be honest, none of these facts are going to take somebody who doesn't know anything about investing and turn them into the best money manager in the world. But that's not the point. For me, the point of these facts is to reinforce good principles. Before I initiate a position, I'm usually keeping these in the back of my mind, really so that I don't stand in my own way. Because as you'll see, that's one of the biggest issues when it comes to investing is human error. So whether you know all of these, whether you know none of them, I hope that you can find something useful here for you to keep in mind when you approach taking your next position or your investing strategy holistically. The first fact I want to talk about has to do with Berkshire Hathaway, Warren Buffett, Charlie Munger. They're 2 of the most successful investors of all time. Now, the fact is this: if you invested in Berkshire's first year, just $1,000 in 1965, today, at the end of 2023, that would be worth $45 million. That is insane. It's like an annualized return of, let's say, 19 or 20% per year over the course of 60 years. This sticks with me for a few reasons. The first is it's a great example of compound interest, something that you may have heard of. Compound interest is the value of larger things compounding over time. So here's the example. In 1965, your $1,000 was worth $1,000. You didn't cross the $1 million mark until 1995. It took 30 years to get there, but then to get to 2 was only 3 years. So this type of thing illustrates, okay, the first one takes 30 years, the second one takes 3 years, then it gets easier and easier and easier. And in fact, getting to that 45, the bulk of this has come over the last 3, 5, 10 years. Between just 2020 and 2023, the increase in the value of this was $16 million. This is only going to continue. And I believe Munger or Buffett had the quote, something like, how do you become so rich you live the longest? It's because you allow your value to compound over time, and then bigger values get increasingly larger, et cetera, et cetera. It's a great reminder for those of us who are investing or paying attention to how we're performing versus the S&P. This is a long game. And the best thing you could do is just not lose and let these amounts slowly get bigger and bigger and bigger. And then eventually you're dealing with sums that are compounding on themselves that will never likely get to the Berkshire levels, but are still really impressive. The last fact I want to say on this topic is that Warren Buffett actually pronounces his last name Buffet, and that is not true. That's a sleep-deprived dad joke. The next thing that is really surprising to me is you hear about these indexes, the S&P 500, the top 500 stocks in the market, the Russell 3000, the top 3,000 stocks. You just look around and think about how many companies are there available to trade, like how many equities are there on the exchanges. And the answer to that is crazy to me, and it's about 3,500. So when you're looking at all of these hedge funds that are trading equities, or how many money managers there are and different stock pickers and whatnot, they're all picking between 3,500 stocks. I thought that this number was going to be at least 10,000. And I find it surprising that like the Russell 3000 is pretty much the majority of the index. Like almost 90% of any stock that you can trade is available in the Russell 3000 index. This number does keep getting smaller. And part of the reason for that is you have private equity funds who are taking public companies private. You have mergers and acquisitions, companies like Procter & Gamble taking over smaller companies. And also there are regulations that aren't as exciting for business leaders to IPO or go public because you have increased regulation, scrutiny, et cetera, publicity, whatever. So all these things are contributing to 20 years ago, there were 20% more companies than there are right now. At the peak, I think it was like 8,000 companies were public, but now we're down to just 3,500. The next fact that I think is crazy, and it's related to this, is that the top 10 companies make up 37% of the S&P 500. If you invest $100 in the S&P 500, as of like June, 37 of those dollars are going to Apple, Meta, Google, like the top 10, Nvidia, the top 10 biggest companies. And I find this wild because the top 10 stocks in the market are driving so much performance and have so much influence on what this index does. There's not really much I do with this information, but it helps me understand maybe why markets move. If Apple's way down, why the whole market is down, because that makes up such a significant portion of the entire S&P 500. So it also helps me realize what my exposure is to those companies. If I'm already in the S&P 500 and I'm thinking about investing in Google and Apple and, Nvidia or whatever, I already have a lot in there. Like 37% of my S&P 500 investment is tied up in those companies. So nothing that is going to specifically make me do something, but just keeping it in mind so that it's a frame of reference, or again, like a different perspective for when I'm thinking about how to approach an investment decision. The next fact is an important call out for those of you who are new to investing, and for those of you who are familiar with it. It's just like a good reminder of the financial industry, I guess, which is over 15 years, like in June 2023, over the last 15 years, 92% of large cap money managers had underperformed the S&P 500 index. There are so many commercials and solicitations and trying to get you to use specific money managers, and you pay a fee to hedge funds who think that they figured out the market and blah, blah, blah. When in reality, the vast, significant majority of these underperform. You're better off just putting your money in the S&P 500. Now, Warren Buffett, even back in 2007 or 2008, had this idea. I think he issued a test with hedge fund managers and picked like 5 or 10 and some fund of funds. And what he found was not one of them came close to outperforming the S&P 500. Of course, there are stretches of the market where the S&P is like the best place to be, but with all of these asterisks, which people will try to, explain hedge fund performance or whatnot, the bottom line is this. I personally use this information because it makes me realize like there are not funds, or my ability to pick a fund that is going to outperform the market and also justify the fees, that is not going to be probable in a better return. It's not. People always say the best thing you can do is just put your money into the S&P 500. Buffett has done this. In fact, Berkshire Hathaway over the last 15 years has underperformed the S&P 500. We're talking about one of the most acclaimed money managers of all time, not producing as well as the index. So if you are brand new to investing and someone's telling you, I got this strategy in the market or blah, all these types of things, just keep in the back of your mind that the vast majority of people, they don't lose money, but when it's reinvesting dividends in the S&P 500 or accounting for their fees, you have over a 90% chance that they will underperform the market. The last thing I want to talk about is timing the market. Now, back in 2021 or 2022, I was thinking about investing in my son's college, right? And I told this guy who was helping me set it up that maybe I'll wait for a couple months in order to put money in the market. And he reminded me, and it was good. He reminded me, don't try to time the market. Now, there are plenty of examples of this. You hear this all over the place, but one really sticks out to me. If you invested $1,000 or $10,000 in the S&P 500 in 2003, I think in 2022, it would be worth like $67,000. I'll put it up in text so you have the exact number. If you miss the 10 best trading days, so only 10 days over that 20-year period, for whatever reason, you would then only have earned $29,000. So missing the 10 best days, missing the 5 best days of the year, however you slice it, is going to drastically handicap your return. So similar to the point above, set it and forget it. Don't, get in your own way. The same thing happens here. Don't wait if you're going to think about investing, because if you miss one of these huge days, you are now behind, right? And I think you can see a common theme in why I'm saying that this type of stuff reinforces my thinking with Buffett. Compounding over time, 23 years to the first million, and then 3 years to the second million. Then you have don't stand in your own way with trying to beat the market. 92% of managers fail, right? And then you have don't miss the top 10 days. So all of this stuff kind of goes to just throw money into the index and forget it unless you have a really good reason not to. I'm not a financial advisor, of course, but these facts help frame things for me and really throttle my overconfidence that I know something that the market doesn't, because as proven time and time again from very, very smart people, the best who do this in the world, it's not easy to beat the market, especially over the years. I would love to know your facts. Help me think about the market differently. I respond to most comments and whatnot. Otherwise, I hope you found this helpful, and I look forward to seeing you in the next one.